morning, everyone. Thank you, Raju, for the introduction. I'd like to thank also SGX and Fast Market for the invitation. My pleasure to be here again and share with you some of our views on how the market will evolve and how Vale is preparing itself for this new market. So as a traded company, I have to take you to the disclaimer. First of all, I'll give you an overview on the steel production forecast. We think steel will continue to grow. Steel production globally will reach about 2 billion tons by 2030 and surpass 2.260 by 2040. It's an impressive growth. It's still 1% compound average growth per year. And I'd like to highlight that China, although we had the recent slowdown in the property sector, you still continue to go strong in steel production. The economy is still resilient, and China will continue for years to come to be the main source of demand for iron ore. Also like to highlight the growth in some emerging regions like Middle East, India, Southeast Asia. We think these regions will be a big source of growth for the years to come. And the structural drivers that we see in the industry will continue. So population and economic growth will continue to play a strong role. Also urbanization, higher intensity of use of steel will also play an important role, especially in the emerging regions. And also in China, we have still a lot of people migrating to big cities. We have the upgrade of the infrastructure in China, which is also playing an important role in steel production. And also we will have new drivers to push the growth of steel production. And the new drivers, I think Raju mentioned about the energy transition. Energy transition will require materials, and steel will be a very important material in this transition. We also see a tendency of reshoring, so more steel being produced near to consuming regions, and that will also help steel production growth. On the near term, we still see strong resilience in the Chinese economy, and China, although the property market is slowed down in the past few years, we see the infrastructure, for instance, is still growing strong in China. So the compound annual growth rate for infrastructure in the last 4 years is about 5.2%. We're seeing a similar trend in auto production is also high at 6.1%. And given the sheer size of the Chinese economy, this is significant growth. Manufacturing is also another sector that's performing pretty well in China. So we see power equipment, strong growth, washing machines, air conditioning. So the quality of life and consumption of people in China is also pushing this growth in consumption. For iron ore, I think we still had the growth in exports, in steel exports, playing an important role in this year. So we are still confident that steel demand and steel production in China will continue to grow. The higher steel production will require more iron ore. Consumption of iron ore will continue to run high. China reliance on important iron ore is very big, so we're still seeing 1.2 billion tons of iron ore being imported into China this year. And the drivers are the ones that I mentioned briefly. So infrastructure is still going strong. Urban village renovation campaign also taking place in China and helping steel production and iron ore demand. We think it's very likely that in the second half we're going to see a positive impact in the property sector given all the stimulus that the government is putting in place. We see manufacturing being upgraded in China, which will also help the steel demand and in turn iron ore demand. There's strong support for EV sales, EV penetration. Now we go to China, big cities in China. You see a huge amount of EVs going around, especially southern China. Recently been to Xiamen, and it's amazing how much it has grown over the years. Solar energy sector is also a big source of demand for steel. And of course, the high share of blast furnace production, of steel making production in China will continue to drive demand for iron ore. Now turning to premiums, we believe that as the steel industry upgrades in China, the premiums will remain high. We've seen over the years the evolution here. I plotted the 65, MB 65 and the MB 58% FE. We see that the differentials, they change over time depending on the state of the steel industry and the profile of consumption. We've seen two periods where the spreads, they have increased a lot. First one was between 2017 and 2018. That's when China introduced the supply side reform. And then, although iron ore prices weren't too high, were about $80, $90 per ton, the quality spreads were very high. So meaning that the mills were seeking productivity, mills were trying to go for the extra ton of steel, also reducing emissions a lot. There was a big campaign to reduce emissions in China by that time. So as a result, the premiums increased a lot. We saw another jump in quality premiums in 2021. That was driven mostly by productivity, higher margins. So high-grade iron ore was the preferred choice of the Chinese steel industry. And although going down a little bit by 2023, 2024, I think the mills went through a period of lower margins, more flexible in the consumption of low grades. We still see significant premiums. We believe as the industry evolves, and then you have new drivers for these premiums in the future, we believe we can see something close to a scenario in 2018 where quality premiums were higher, although the base iron ore price lower. So the steel industry continues to evolve. We think the premiums will continue to be a relevant part of the industry. As the mills shift to greener and more expensive use of more expensive reductants, the quality premiums will play an important role. The aging plants will need to upgrade. That will also be a good source of demand for higher grade iron ores. As carbon pricing, carbon tax hit the market, we also believe that the premiums of those ores that reduce the emissions need to be higher. And of course, as Raju mentioned as well, the undersupply of high-grade products, especially agglomerates, will create this two-tier market where the high-grade ore will trade at a differentiated premium. As market evolve, we share a similar view. As far as markets, we think there will be an undersupply of agglomerate products. On the BF side, demand should be growing at about 2%. So BF pellets and lumps will see similar growth. There's still a gap in supply and demand for BF agglomerates, but not as strong as on the DR side of things. So the DR market is growing at about 15%, so everybody's trying to reach decarbonization goals, and DR demand will grow as well. The only problem here is that supply will struggle to catch up. We don't have enough high grades to supply the needs of the market, and we'll see a big gap which will turn into increasing premiums for DR grade markets. So the 70 million supply and demand gap in 2030, Vale will be able to supply some of those that gap, and we have the flexibility and the advantage to do so, given that we have high iron ore reserves. So Carajás alone has 6 billion tons of reserves, worth of 66% Fe quality, very low impurities. Carajás material can even be concentrated to even higher grade. We have a lot of ores suitable for beneficiation. So in the southern system, we have ores that we can beneficiate up to DR grade feed quality. We have also Carajás being suitable for beneficiation. So we're very well positioned in that area. And we had the core competencies to develop beneficiation. We've been doing so for more than a few decades in Brazil and also in agglomerates. We've been producing pellets for a long, long time. We already have a big portfolio of pellets, about 40 million tons a year. And now we are developing a new product which we call the briquettes. To enable all this growth, we are investing a lot in these new industrial complexes, which are calling mega hubs. These complexes will have concentration, Production of agglomerates can be pellets, briquettes, and we started this journey in 2022 when we signed first agreement with local authorities in the Middle East. By 2023, we signed MOU with different partners. We now sign more than 30 MOUs with partners around the world. We have plans to build mega hubs in different parts of the globe, not only the Middle East, but also we are studying opportunities in Brazil and the US. And we expect to have the first mega hub starting up in 2027. In terms of volumes, the preliminary estimates that we have is to produce about 15 million tons of briquettes by 2027, another 15 million tons after 2032, and that will translate in a production of HBI equivalent of about 20 million tons in that period. HBI will be produced by a partner that will bring to manage the production and also allocate the sales, but we are very flexible in the structure of these mega hubs, so different options can be studied as well. Through the increase of agglomerates production, we are reshaping our portfolio. We are producing more tailored products to our clients. We see that the industry is developing in a way that they will demand more and more of agglomerates, and we are preparing our portfolio to be able to cater to the industry. As I mentioned before, we produce around 40 million tons of pellets already, DR, MBF grade. We are increasing the production of briquettes, and by 2030, we are foreseeing a production of over or around 100 million tons of agglomerates, being DR agglomerates, BF agglomerates, pellets, and briquettes. On the left-hand side, we can see a pile of briquettes in the Espírito Santo plant in Tubarão, Brazil. We expect to produce 1.5 million tons of briquettes in 2024. And the economics of briquettes are very attractive. They have similar VIU to pellets, although the cost of producing a briquette is 50% lower than the cost of pelletizing. The capital intensity for a briquette plant is about 66% lower than a pelletizing plant. And most importantly, the CO2 emissions are significantly lower at 80% less. So it's more efficient to produce briquettes. It's more efficient not only economically, but also to the environment. And we are on track also to increase not only the agglomerates capacity, but also the fines capacity. So 2023, we produced 321 million tons, so above the target that the guidance that we provide to the market of 315 million tons. The average quality is 62.5%, so it's a very good quality portfolio. We have different products. We have 58% to 65%. We have pellets, and in average, it's about 62.5%. In 2024, we released a target to the market to produce something between 310 and 320. We're tracking very well in that forecast. The first quarter, we produced 71 million tons, if I'm not mistaken, and Carajás produced 18 million tons, 18. Was the highest production in Carajás since 2020, and overall in Vale was the biggest first quarter production since first quarter 2019. So we are on track, we're recovering our production, and we're developing several projects to increase our capacity by 50 million tons. So we have Vargem Grande expansion, we have Capanema, S11D. I think FIFA will touch more details in the next panel about these projects. And this accounting for licensing, depletion, and others, and it's very important because usually the industry don't pay much attention for depletion. It's something that it's been affecting all the mining operations in the world, and it requires a lot of investment, a lot of effort, a lot of hard work to overcome depletion. And accounting for depletion and and capacity that's being taken out of the market, we might produce by 2026 around 300 and 360. So, of course, this production will be put into the market if the market requires. We have the flexibility to deliver a different portfolio depending on the market demand. And most importantly, the quality, the average quality will increase significantly from 62.5 nowadays to about 63.5%, with a higher share of agglomerates, a higher share of high-grade products in our portfolio. By 2030 and above 2030, we'll be able to produce 360 million tons, meaning that we'll have 360 million tons of production capacity. But again, we'll look at the market demand, see what kind of products the clients are demanding, and then we can have some flexibility on this capacity. And also important to note that the quality will improve even further to 64%. So to enable this growth, we work hard on licensing. We're already working very hard. So licensing became more and more stricter in the past few years. And we have a new approach with the authorities. We are working very collaborative with the authorities in Brazil to get the licensing process more smooth and easier for everyone. So the licensing will help us preserve the baseline of our production. As I mentioned, we have the projects, so all the growth that we'll see in this year will come from these brownfield projects. And the capital intensity is pretty low, about 45 to 60. We see that greenfield projects, they have a much higher capital intensity. So it's a big advantage for us being able to develop these projects in-house. Quality, I think as we develop these high-grade deposits, we have an increase in quality. And of course, if we develop also developing the concentration, developing the briquette plants, that will also help on the quality side. So that will ensure that our portfolio increases quality and is a quality suitable for the needs of the steel industry. So we are at a turning point in Vale. So we are stabilizing the production, the baseline production. We have capacity growth, and we are improving the quality. So all of this will enable a strong growth, not only in volumes, but also in quality from 2023 to 2026. Iron ore volumes, as I mentioned before, we produced 321 million tons in 2023. We're looking to 340, 360 by 2026. The high-grade agglomerates, which is now roughly 37, 36 million tons a year, we're going to produce 50 to 55 million tons in the span of 3 years. So this is a very positive improvement in our product portfolio, and it's much welcomed by our clients. At the same time, we are keeping our costs low. So C1 costs about $22.3 per ton in 2023. And with increased capacity, increased efficiency, we are looking to have C1 costs lower than $20 per ton. So for my final remarks, we're building a true customer-centric iron ore solutions company in Vale. So we're reshaping the portfolio. We're working hard to increase our production capacity. We're working hard on increasing the quality of the production capacity as well. So decarbonization is a big trend. It's a trend that is creating a segmented iron ore market. So the high-grade segment will grow a lot. We believe that the premiums will also have to grow in order to cater for this growth. There are a lot of investment that needs to be made on not only the steel industry to decarbonize and to follow the goals and to reach the goals of decarbonization, but also big investments in the mining side will be needed. Our customer-centric approach and product differentiation is an advantage, is a competitive advantage of Vale. So now we're looking on what the industry needs, and we are shaping our portfolio to cater for the needs. So we have the capacity to do so, and with the mega hubs and with the new projects in Brazil, we are pretty sure we can achieve our targets. We have a diversified portfolio of products, as I mentioned before, from low grades to high grades. But as we see the market evolving towards more high grades, we are reshaping this portfolio to be able to provide more of the high grades to the industry and also increase our share of agglomerates. All of this will enable the creation of substantial value, not only to our clients, but also to the society and to all the stakeholders. Well, thank you so much.